Assalamualaikum warahmatullahi wabarakatuh. My name is Ihan Syahmi binti Ghazali. So my group will present about association of valuation and allocation. So before I was go through for valuation and allocation, first of all, we have to know what is association in financial statement. In this statement is said financial statement association or management association are a company official statement that the figures the company is reporting are accurate. Investor and analysts rely on accurate statements to evaluate a company's stock. Otherwise, metrics such as the price to book ratio and earning per share would be misleading. The Financial Accounting Standard Board requires public trade companies to prepare financial statement following the generally accepted accounting principle that's called GAAP. So, companies must attest to assertion of existence, completeness, and obligations, accuracy and valuation, and precision and disclosure. So we go through to the what is valuation and allocations. SAS 31 states assertion about valuation or allocation deal with whether assets, liability, revenue, and expense component have been included in the financial statement at appropriate amount. The auditor has the guidance of GAAP to measure or disclose transaction and balance. On the surface, the assertion appears to be one of the least troublesome. However, the auditor should determine the audit procedure selected are suitable for accomplishing the audit objectives related to the assertion. For example, confirmation of account receivable provide valid evidence relating to the assertion of existence. However, the fact the client customer indicate that the amount on the face of the confirmation is provide little. If any evidence the payment is issued, valuation can be supported by the processes of aging the current account receivable to evaluate the adequacy of the allowance account. So next is audit assertion. Audit assertion are a representation by management that is embodied in the financial statements. This representation may be explicit or not. Assertion are used by the auditors to assess misstatement and obtain evidence. So here we know audit assertion have three types. First is items appearing in the profit or loss statement, items appearing in the balance sheet, and presentation and disclosure. So for valuation and allocation in profit and loss assertion, profit or loss statement show profit or loss for the period. There are 5 profit or loss assertion with occurrence: completeness, accuracy, classification, and cut-off. You are reading the article because you want to know what audit assertion you need to consider. Why conducting an audit of profit or loss statement? This is why scale accounting have explained each of the assertion in details. So for valuation and allocation in this profit or loss assertion, that all transactions are recorded with the appropriate amount. A transaction is considered accurate if first is there is no error while preparing the supporting document. Second is there is no error while posting this transaction. Example of valuation and allocation. We know when we consider the above example sale of 5,000. So how will you test the valuation and allocation? This is simple step. We have to know how to we got the valuation and allocation. First, we have to select a sample of entry from sales ledger. We calculate the amount on sale invoice and check whether control account calculation are in place. And next is accuracy is an pattern audit related to transaction during the period. In the balance sheet assertions, balance sheet or statement financial position has 4 assertions. So here we just explain the valuation and allocation balance sheet assertion through an example. So here is assertion. It means that all assets, liabilities, and equity are recorded to the correct amount, and any adjustment relating to the valuation of assets, liabilities, and equity have been recorded. So how to test valuation and allocation assertion is select a sample of fixed assets from fixed asset register and obtain voucher to perform vouching of the purchase cost. Similarly, recalculate the depreciation, expense, and loss or gain on disposal. Obtain the breakup of any addition made to fixed asset during the period. Then perform vouching on a sample basis to ensure the accuracy of the amounts. So next is assertion may be classified into the following types. First is assertion relating to assets, liability, and equity balance at the period end. So for assertion is valuation. So for their explanation is assets, liabilities, and equity balance have been valued appropriately. Example, inventory has been recognized at the lower of cost and net realizable value in accordance with IAS 2 inventories. Any cost that could not be reasonably allocated to the cost of production and any abnormal wastage has been excluded from the cost of inventory. An acceptable valuation basis has been used to value the inventory cost at the period end. The second is assertion relating to presentation and disclosure. So for accurate evaluation, to their explanation is transaction, events, balance and other financial matter have been disclosed accurately at their appropriate amount. Such example is related party transaction, balance and event have been disclosed accurately at their appropriate amount. So that's all for me. Next, I have give to my second presenter is Nova Hisham. So thank you.
Okay, asset valuation for tangible. To compute the net tangible assets of a company, the company needs to look at its balance sheet and identify tangible and intangible assets. From the total assets, deduct the total value of the intangible assets. From what is left, deduct the total value of the liabilities. What is left are the net tangible assets or the net assets value. Okay, for example, the balance sheet total assets is $10 million. The total intangible assets is $3.5 million. The total liabilities is $2.5 million, and the total tangible assets is $6 million. Okay, in the example that we given, the total assets of the company equal to $10 million. When the total intangible assets of $3.5 million are deducted, that will leave $6.5 million. After the total liabilities are deducted, which is another $2.5 million, only $4 million is left, which is that is the value of the net tangible assets. Okay, assets valuation for tangible. To compute the net tangible assets of a company, the company needs to look at its balance and identify the tangible and the intangible assets. From the total assets, deduct the total value of the intangible assets. From what is left, deduct the total value of the liabilities, and what is left are the net tangible assets or the net assets value. Okay, assets valuation for intangible assets. For example, a multinational company with assets of $15 billion goes bankrupt one day, and none of its tangible assets are left. It can still have value because of its intangible assets, such as its logo and patents, that many investors and other companies may be interested in acquiring it. Okay, for the importance of the asset valuation. Asset valuation is one of the most important things that need to be done by companies and organizations. There are many reasons for valuing assets, including the following terms. For the first one, right price. Asset valuation helps identify the right price for an asset, especially when it is offered to be bought or sold. It is beneficial to both the buyer and the seller because the former would not mistakenly overpay for the asset, or will the latter erroneously accept a discounted price to sell the asset. For the second, company merger. In the event that two companies are merging, or if a company is to be taken over, asset valuation is important because it helps both parties determine the true value of the business. Okay, the third one, loan application. When a company applies for a loan, the bank or financial institution may require collateral as protection against possible debt default. Asset valuation is needed for the lender to determine whether the loan amount is covered by the assets as the collateral. Okay, last, audit. All public companies are regulated, which means they need to present audited financial statements for transparency. Part of the audit process involves verifying the value of the assets. Okay, for the purpose and importance, Assertion assists auditors in considering a wide range of issues that are relevant to the authenticity of financial statements. The consideration of management assertions during the various stages of audit helps to reduce the audit risk. Okay, that's all. Thank you.